Welcome everyone. I'm here to tell you a truth. Finance is not just for Wall Street experts. It is for you. It is for everyone. It is about you taking control of your money. And by doing that, taking control of your life. Please do not be afraid of money talk. You need to face your finances head-on with courage. This knowledge you are about to gain is power. It is real power that will secure your future. Accounting and finance might sound very complicated, I know. But please listen to me. They are just tools. Simple tools designed to help you understand money better. Accounting is like a history book for your money. It carefully tracks where your money went, every penny. Finance, on the other hand, helps you plan. It helps you decide where your money will go in the future. You absolutely can master these tools. I have seen so many people do it, and I know you can too. Why should you care about all of this? You should care because your dreams depend on it. Think about what you want in life. Is it buying a beautiful home for your family? Is it retiring with dignity and no money worries? Is it sending your children to college without debt? All of these important goals need a solid money plan, and a smart, effective plan always starts with understanding. It starts with understanding these core financial ideas. This journey we are starting will make you stronger, I promise. It will make you feel more secure and confident. We are going to cover many important topics together. We will look at financial statements, those money reports. We will learn about financial ratios, the health indicators. We will discuss investing, economics, and even government policies. Step by step, you will understand it all. You are so ready for this. Let's begin. First, let's talk about income statements. You might have heard it called a profit and loss statement. Many people shorten it to P&L. This important statement tells you a very simple thing. It tells you if a business made money, or if it unfortunately lost money. It covers a specific period of time for this. It could be for 1 month, 3 months, or 1 whole year. It is a crucial report. Think of the income statement like a report card, but instead of grades, it shows financial performance. Did the company pass the test of being profitable? This statement clearly lists all the money coming into the business. This is called revenue or sales, and it lists all the money going out. These are the costs and expenses. It is a very important story about money management. It tells you if the business is winning or losing. The very first big number you will see is revenue. This represents all the money earned by the business. It comes from selling products to customers or from providing services to clients. It is the total amount of sales generated. This is calculated before any costs or expenses are taken out. Revenue is the starting point of the statement. It is often called the top line for this reason. A strong top line is a good start. Next, from the revenue, you subtract the cost of goods sold. This is often called COGS. These are the direct costs involved. The costs to actually make the products the company sells, or the direct costs to deliver the services it offers. When you subtract COGS from revenue, you get gross profit. This figure shows the profit made before other operating expenses. It is a key number to watch closely. Then, other operating expenses are deducted to arrive at the net income or the bottom line. Now let us turn our attention to the balance sheet. This financial statement is quite different from an income statement. The income statement covers a period of time, like a year. The balance sheet, however, is a snapshot. It tells you what a company owns and what it owes. It does this for one specific day, a single point in time. Think of it like taking a clear photo of a company's financial health on that day. The basic formula for the balance sheet is simple. It is fundamental. Assets must equal liabilities plus equity. So A equals L plus E. It must always balance. That is precisely why it is called a balance sheet. Both sides of this equation must be perfectly equal. There are absolutely no exceptions to this rule. If it does not balance, there is an error somewhere that needs to be fixed immediately. This balance is key. So, what are assets? Assets are all the things a company owns. These are resources that have economic value. Cash in the bank is a very common asset. Buildings, machinery, and office equipment are also assets. Money that is owed to the company by its customers is an asset too. This is often called accounts receivable. These are all good things for a business to have on its books. They are the resources the business uses. Then we have liabilities. Liabilities are what a company owes to others. These are its financial obligations or debts. Loans taken from a bank are common liabilities. Money owed to suppliers for goods or services is another. This is often called accounts payable. Deferred revenues, which is money received for services not yet provided, are also liabilities. Equity represents the owner's stake in the company. It is the net worth, the value belonging to the owners. The third absolutely key financial statement is the cash flow statement. This one is so very important, please listen closely. Showing a profit on paper like on the income statement is one thing, but having actual cash in the bank account is the reality. This statement meticulously tracks the movement of actual cash. It shows all the cash coming into the business, and all the cash going out of the business. Profit does not always mean a company has cash. A business can report a profit, but it can still find itself with no cash in the bank. This really does happen more often than you think. That is why you must understand the cash flow statement. It reveals the real, true flow of money within the business. Without sufficient cash, a business simply cannot survive. Not for long anyway. Cash is king, always remember that. The cash flow statement is usually broken down into three main parts. The first part is cash flow from operating activities. This section shows cash generated or used from the normal, day-to-day business operations. This includes cash from selling goods or providing services, and cash paid out for things like salaries and suppliers. This section should ideally be positive. It shows the core business is generating real cash. Then, there is cash flow from investing activities. This part tracks cash used for or cash received from buying or selling long-term assets. These are things like property, new machinery, or equipment. It also includes investments in other companies. Finally, there is cash flow from financing activities. This covers cash related to borrowing money or repaying debt. It also includes issuing company stock or paying dividends to shareholders. This statement truly reveals the complete cash story. Alright folks, Section 5 is all about health checking your finances with key ratios you must know. Now, financial statements, they provide you with a ton of numbers, right? Lots and lots of numbers, it's true. But, what do all those numbers really mean for a business? Well, financial ratios are the tools that help you understand. They turn all that raw data, those plain numbers, into valuable insights. Ratios help you to compare a company's performance. You can compare it over different time periods or, against other companies in the same industry. First, let's dive into liquidity ratios. These ratios answer a critical question. Can the company pay its short-term bills and obligations? The current ratio is a very popular and widely used liquidity ratio. You calculate it by dividing current assets by current liabilities. Generally, a ratio that is above 1 is considered good. It suggests the company has more short-term assets than short-term debts. The quick ratio, or acid test ratio, is stricter. It excludes inventory from current assets because inventory can be harder to turn into cash quickly. Next up, we've got profitability ratios. These ratios tell you something vital. How good is the company at actually making money? The gross profit margin shows the profit on its sales after deducting the direct costs of producing those goods. The net profit margin shows the company's profit after all expenses, including taxes and interest, have been paid. Higher profit margins are almost always better. They indicate strong pricing power and good cost control. Then, we have efficiency ratios, also known as activity ratios. These ratios measure how efficiently a company uses its assets. The inventory turnover ratio shows how quickly a company sells its inventory. A higher turnover is usually better. The accounts receivable turnover ratio shows how quickly the company collects money owed by its customers. These ratios tell you if the business is running smoothly, or if there are potential operational problems that need addressing. Section 6. Making money grow. Smart investment analysis. Investing is all about making your hard-earned money work for you. It should not just be sitting idle in a low-interest bank account. The goal of investing is to grow your wealth over time so you can achieve your long-term financial goals. For your retirement, for your children's education, for your future. But how do you choose good investments? How do you avoid bad ones? You need reliable tools for proper investment analysis. You need smart tools. One very important tool for this is called net present value. You will often see it abbreviated as NPV. A fundamental concept in finance is that future money is worth less than the same amount of money today. This is known as the time value of money. Why? Because money today can be invested and earn a return. NPV calculates the total value of all expected future cash flows from a particular investment, expressed in today's dollars. The rule for NPV is quite simple. If the net present value is positive, the investment is generally considered good. It means the investment is expected to earn more than your minimum required rate of return or discount rate. A negative NPV, on the other hand, means you should pass on it. The project is not projected to make enough money to meet your target. It is as straightforward as that. You must listen to what the NPV tells you. Another very useful tool is the internal rate of return, or IRR. The IRR is the specific discount rate at which the net present value, NPV, of an investment becomes exactly zero. You can think of it as the investment's inherent expected rate of growth or its effective compound interest rate. If the IRR is higher than your target rate of return or higher than the cost of capital, then it could be a very good investment to consider. Section 7. Your wallet and the world, micro versus macroeconomics. Let's switch gears a little bit now. We are going to talk about economics. I know it sounds like a big and scary subject, but at its heart, economics is just about choices. It is about how people, businesses, and governments make choices, especially when they have limited resources like time or money. There are two main branches of economics. They are microeconomics and macroeconomics. Both of these are very important to understand. Microeconomics looks at the small picture of the economy. It studies the economic behavior of individuals. It looks at households and single businesses or industries. How do you, as a person, decide what to buy with your money? How does a single local store decide on the prices for its goods? Microeconomics examines supply and demand for specific products or services. Your everyday financial decisions are a part of microeconomics. It is personal. Microeconomics helps us understand how markets work. Why are some things like designer bags so expensive? Why are other things like basic foods relatively cheap? How do different businesses compete with each other in the marketplace? Microeconomics provides the framework to answer these kinds of questions. It is the foundation, the building blocks for understanding how our entire economy functions. Right from the ground level up, it shows individual actions. Macroeconomics, on the other hand, looks at the big picture. It studies the entire economy of a country, or sometimes even the global economy as a whole. It focuses on broad aggregates, things like national income, overall price levels, inflation. It looks at total employment, unemployment rates, and economic growth rates. Government policies like tax changes or interest rate adjustments often focus on these macroeconomic issues. These big forces affect absolutely everyone. Section 8. The economy's pulse, vital economic indicators. How do we actually know if the overall economy is healthy, or if it is perhaps sick and needs some help? We use things called economic indicators to tell us. These indicators are like taking the vital signs of an economy. Just like a doctor checks your pulse and temperature, they tell us what is really going on. They help individuals and businesses make informed decisions. Business decisions about expansion, and personal decisions about spending or saving. One of the biggest and most watched indicators is gross domestic product. You will almost always hear it called GDP. This number measures the total monetary value of all the finished goods and services produced within a country's borders, usually in a single year. If the GDP is growing, it generally means the economy is expanding. More goods are being made, more services are being provided. That is generally very good news for jobs and incomes. Another crucial indicator is the Consumer Price Index, or CPI. This indicator measures inflation. It tracks how fast the average prices for a basket of everyday consumer goods and services are rising. This basket includes things like food, housing, clothing, and transportation. High inflation erodes your purchasing power. It means your money buys less than it did before. That is why we watch the CPI figures very, very closely each month. And then there is the unemployment rate. This indicator tells us what percentage of the total labor force is currently jobless. But importantly, they must be actively looking for work. A low unemployment rate is a sign of a strong economy. It means most people who want jobs can find them, and they have income to spend, which helps businesses grow. These key indicators together paint a clear picture of economic health. They guide policy and personal choices. Section 9. Steering, the economy, policy, and your money. Governments and their central banks actively try to guide the economy. They have certain goals in mind for the nation. They usually want stable and sustainable economic growth. They aim for low and predictable inflation, and they want low levels of unemployment. To achieve these goals, they use two main types of policy tools. These are monetary policy and fiscal policy. These policies can and do have a direct impact on your money. Monetary policy is typically managed and implemented by a country's central bank. In the United States, this is the Federal Reserve, often called the Fed. The central bank's main tools involve controlling the money supply and influencing interest rates throughout the economy. For example, if inflation is too high, the Fed might raise interest rates. This makes borrowing money more expensive for consumers and businesses. This can help to cool down an overheating economy and reduce price pressures. Fiscal policy, on the other hand, relates to government spending and taxation. These decisions are usually made by the government's legislative body. For instance, Congress and the President in the United States decide fiscal policy. If the economy is slow or in a recession, the government might increase its spending. It could spend on infrastructure projects like roads or bridges, or it might decide to cut taxes. The idea is to give people and businesses more money to spend or invest. So why does all of this matter to you and your finances? These policies directly affect you. They influence the interest rates you pay on your mortgage or car loan. They impact job availability in your area. They affect the prices you pay for goods and services. Understanding these policies helps you make smarter financial plans. For your investments, for your major purchases, for your overall financial security. Be informed, be prepared. You are in charge of your financial destiny now.